And let's take a few minutes and talk about the learning objectives here. At the end of this session, we're hoping that you will be able to identify clients to whom the required minimum distribution rules apply. And by the end of the session, you'll understand why this is very important. The separate accounting rules will also be discussed. And this is very important because an increasing number of individuals are inheriting retirement accounts and do not understand how these rules could impact the amount of distribution they eventually receive. And from a general perspective, we're going to be looking at some transactions that must be completed by the end of the year in order for your clients to benefit from these provisions. You know, I was talking to some clients yesterday and I told them about this presentation, and one of my clients said to me, so what's the big deal if someone misses a deadline? They can just do that transaction in January. But we're going to show today why that is not the case. If an individual misses some of these deadlines, they will miss opportunities for tax advantage solutions. There could be IRS penalties, and there could be recapture tax and IRS assessed interest on some of the transactions. The first topic we want to talk about is the required minimum distribution. And if you've been in the retirement plan field for a year or more, it's very likely that you have heard about the required minimum distribution rule. It's talked about a lot, but I'm finding out that not many people understand how this rule works and the penalties that could apply if individuals do not understand the rules and miss their deadlines. So the first question becomes, what is a required minimum distribution? Well, by definition, a required minimum distribution is a minimum amount that must be withdrawn from a retirement account for a year. Now, until an individual reaches age 70 and a half, distributions are usually optional, and I'm emphasizing usually because there's usually some exceptions. Generally speaking, if an RMD, or required minimum distribution, is due for a year, it must be withdrawn by December 31st of the year for which it is due. So now the question becomes, who is subject to this required minimum distribution rule? Generally speaking, individuals who are at least age 70 and a half and older, and beneficiaries. And you'll hear me say generally speaking a lot, because when we discuss the rules that apply to IRAs, there's almost always an exception to the general rule. It is important to note that the RMD rules do not apply to IRA owners. And you'll see me have owners on the line here because it does apply to beneficiaries of Roth IRAs. And that's one of the mistakes that is usually made by, unfortunately, some retirement account owners and some professionals as well. They think that because the RMD rules do not apply to Roth IRA owners, they do not apply to beneficiaries, and that's not the case. So the beneficiary rules that we're going to be talking about here today do apply to Roth IRAs.